Hi, welcome to this chapter 6 of the Little Book of Valuation. In this chapter, we're going to talk about valuing young growth companies. Kind of an extension of what we did in the last chapter, but a deeper dive into what it is that makes young growth companies difficult to value. To set up the question, let's start by stepping back and looking at what characterizes young growth companies. When you look at young growth companies, here's what you will see in many of these companies. You see revenues growing strongly. Revenues. You might actually see operating losses. Why? Because the company is still struggling putting a business model together. There are some young growth companies that make money, but many of them are still struggling, so they have losses. And they'll have even more negative cash flows because they're reinvesting to create future growth. So soaring revenues, high revenue growth rate, partly because they're building off tiny revenue bases, losses, and negative cash flows. So with that set up, let's think about what it is that makes young growth companies so challenging to value. First is they're young. What does that mean? You don't have much historical data. If your response is so what, think of how much in valuation we just extrapolate the past. Having 10 or 20 years of data makes your life easier. But in the case of young companies, you don't have much historical data. Second, their existing revenues are small or perhaps even non-existent. Many young companies can be pre-revenue companies and they have operating losses. Again, much of valuation, especially in its simplistic versions, you take existing revenues and grow them. You take existing margins and extrapolate them. You can't do that with a young growth company. Third, many young growth companies don't make it, don't survive. In fact, the Bureau of Labor Statistics that maintains a database of all startups in the US. If you look at that database, only 45% of the companies that were founded in 2006 made it through 2011, 5 years, and only 24% made it through the next 15 years. 76% failure rate. Much of that failure is front-ended. A lot happens in the early years. This is not always the case, but many young growth companies, especially if they're very young, tend to be privately owned by venture capitalists. They're not liquid, and that illiquidity can affect how much you pay for an investment. And to the extent that they're still private companies raising money from venture capitalists, each venture capital round is so unique that it creates a distinct class of equity. It's like having 5 or 6 different voting right classes or rights classes in your equity. And finally, because these companies have negative cash flows, but they still need to attract employees, they have no choice but to use stock-based compensation, restricted stock units and options to reward their employees. Again, none of these are unique to young growth companies, but they're particularly visible in young growth companies. So from a valuation and a pricing perspective, let's see how this plays out. When you try to value a young growth company, most of your value comes from future growth. It doesn't come from existing assets. It doesn't come from book value. That's going to be challenging because everything is in the future. And when you're pricing these companies, you run into the same issue. Why? Because first, remember, to price something, you got to scale the price to a variable. Now, normally we scale price to earnings or book value. Neither will work with a young growth company. With earnings, you often have losses. With book value, there's nothing there. Even revenues, you have tiny revenues. So basically, deciding what to scale it to is a challenge. Second, how do you find comparable companies? All the other companies, just like yours, are all privately owned and venture capital funded. It's really difficult to get the pricing for these companies. And finally, even if you can get past those first two challenges, what to scale it to in comparable companies, how do you adjust for the failure risk? So those are the questions I'd like to answer. So let's start with the intrinsic value side. Let's suppose your challenge when you sit down to value young growth company is twofold. First, estimating revenues for this company over time. Remember, there's very little to go on right now in terms of historical data, and you got to project out the revenues from the future. Let's lay out what you might look at to make that estimate. First is you have to get a sense of what that total market you're going after. In fact, in Silicon Valley, this became a buzzword, total addressable market, TAM. But basically, it's not a buzzword. It really is critical to valuation. What is the total market you're going after in terms of the product, in terms of geography? The larger the total market, the greater your potential revenues can be. The second is the share of that market your company will command in steady state. You might say, how do I know that? Well, it depends on how you characterize the market you're in. Is it a networking benefit market where a few companies will end up dominating, or will it be a splintered market? If it's going to be a splintered market, your market share has to be far smaller than if it's a winner-take-all market. So estimate the total market and your market share. That's going to give you revenues. You also have to make a judgment on how quickly you will scale up to those revenues. Is it going to be a company where the growth is going to be front-ended and you're going to get a lot of growth in the next 2 or 3 years? Is it going to be more spread out over time? That might depend on both the quality of the product and service the company provides as well as the management. Let's face it, it's very difficult to tell a story about a young growth company that doesn't factor in the quality of the management, how much you trust them to be able to convert this great idea into a business. So the company I'm going to use to illustrate this process is Airbnb. Airbnb at the time of its IPO in November 2020. If you think about it, a very strange time for a hospitality company to go public because COVID had shut the global economy down. In a strange way, Airbnb had benefited from the shutdown, not because they weren't hurt, but because everybody else around them in this business, the hotel companies, were hurt even more. So in the last 12 months leading into the IPO, Airbnb had revenues of about gross bookings of about 26.5 billion. Now think about the Airbnb model. It's a platform. People come and use it to make a booking of an apartment or a house. That's the gross booking, the amount they spend. But Airbnb gets only a percentage of that in the 12 months leading into their IPO. That percentage was about 12.65%, which is what I'm going to keep for year one as the percentage of the gross bookings. In my story, I see those gross bookings going from about 26 billion, which is what they're now, to almost 156 billion. That'll make them one of the biggest intermediaries in the hospitality business. You see, how do I know whether it should be 160 billion or 500 billion or 700 billion or 2 trillion? It depends on the total addressable market here. The total addressable market in 2020, at the time Airbnb went public, was relatively modest. I mean, all of the hotels in the world put together had collected revenues of about 700 billion. 160 billion would be almost 1/5 or 1/6 of that number. So that's going to determine this. And I do think Airbnb is going to expand the market by bringing in new users. So in my story, the total addressable market is going to be about 1.2 trillion, and Airbnb is going to capture more than 10% of that market. So basically, my assumption about market share is playing out in the gross bookings. I also assume that Airbnb's share of those gross bookings will rise over time to hit about 14%. So that is my core model to get revenues. Let's move to the second big input. How profitable will Airbnb be once it gets past the growth pains? To make this assessment, you again have to understand the core business. Airbnb, like Zomato in the previous chapter, is an intermediary. As an intermediary, the unit economics should work in your favor. So the target margin should be a fairly high number. But basically, you got to make a judgment not just on what the margin will be, but how quickly you will move to that margin, a pathway to profitability. Some companies have smoother pathways than others, and your story has to incorporate it. So in my story, I will assume that Airbnb will have high margins and evolve to those margins fairly quickly, but that has to become part of your story. Now, to get to cash flow from your earnings, you need reinvestment. Now, in the case of a company like Airbnb, that reinvestment doesn't take the form of building apartments or buying houses. They don't own them. It'll take the form of making their platform more powerful, acquiring other companies, R&D, new patents, intangible investments, but they got to spend money anywhere. And historically, if you look at Airbnb, they've had to reinvest to get to where they are today. So to estimate how much they will continue to reinvest in the future, I looked at two other companies, Expedia and Booking, which have business models pretty close to Airbnb. I mean, I could have looked at hotels, but hotels have a very different reinvestment model, more capital intensive than Airbnb's. And it looks like, given what Booking.com and Expedia and Airbnb have done in the past, that this is a business where you get about $2 in revenues for every dollar in capital you invest. So now with the profit and the reinvestment story for Airbnb, I am ready to go from my after-tax operating income to expected free cash flow of the firm. So I start with the revenues that I projected out earlier. I assume the margins, which right now are negative, big negative numbers, minus 22.6%, will improve fairly quickly over time to become positive by year 3, and then build up to a steady state margin of about 25%. How did I get the 25%? I actually looked at Booking and Expedia. Booking.com has slightly higher margins, about 30%. Expedia has much lower margins, about 9%. I essentially assume that competition among these platforms would keep the margins from exploding, so I've used a target margin of 25%. So as my operating margin goes from negative to positive, my operating losses, the EBIT, becomes operating profits. But that's just my operating profit. To get from operating profit to after-tax operating profit, I need a tax rate. For the next 4 years, there are no taxes. Now you can see why there are no taxes for the next 2 years. You're losing money. But for the years afterwards, I'm carrying my net operating loss forward. I have zero tax rate in years 3 and 4. And even in year 5, I pay only a partial tax rate. So my after-tax operating income, as in the previous chapter when I valued Zomato, incorporates my tax benefits. My reinvestment each year is computed by taking the change in revenues. So if you look at 3.6 to 4.69 billion, about $1 billion increase in revenues, and dividing by 2. That's a reinvestment. So it's as simple as that. I am assuming that reinvestment and revenues occur contemporaneously. If you reinvest, you get your revenues right away, because that's a kind of business Airbnb is. And if you do an acquisition, the kind of reinvestment. Now, could I have built a lag in here where I have a 3-year lag between my reinvestment and my revenues? Absolutely. All I'd have to do then is take the change in revenues from year 4 to 5 and use it to compute my reinvestment today. So in my last column, you see my free cash for the firm. And you can see that in my upbeat, optimistic story for Airbnb, I end up with a free cash flow to the firm that is negative for the next 6 years. And then it builds up, it turns positive, and by the terminal year, I see Airbnb being a significantly profitable company with large positive cash flows. So we're almost there. We have the free cash flow. We need to discount it back. To start the game, I use a cost of capital of about 8.5% for Airbnb. At the time that I did this, that will put them at about the 80th or 90th percentile of US companies, a risky company. But over time, I see the cost of capital decreasing as Airbnb gets bigger and more profitable. But because my cost of capital is changing, I have to use that cumulated cost of capital that reflects the changing cost of capital over time. And I've worked out the mechanics of doing this. So basically, to compute the present value, I divide the free cash flow of the firm by the cumulated cost of capital. And remember, there is the elephant in the room, the terminal value. The terminal value reflects what I think Airbnb will be worth at the end of year 10. And to make that valuation, I assume, as I did with Zomato in the previous chapter, the company would start to grow at a stable growth rate in perpetuity. The growth rate is low because I'm doing things in US dollars, and in 2020, that rate was much lower than the rate you saw in Indian rupees when I valued Zomato 2 years later. Add up the present values. The total value that I get for the operating assets is about 29.6 billion. Now, of course, as I said, there is a chance of failure. And I know people try to bring failure risk into discount rates. It's a hopeless exercise. Discount rates were never designed to capture failure risk. Discount rates are instruments to capture the risk of a company as a going concern. So if you want to bring failure risk in, here's what you have to do. First, you have to estimate a chance of failure, a probability of failure. And second, you have to tell me what will happen if you fail. What will happen in the sense of you're going to sell off the assets, their liquidation value, what will my equity be worth? In the case of Airbnb, here's what I assumed. I assumed a 10% chance of failure, and if they fail, they're going to get half of their fair value. Why? Because you have to sell in a hurry. People are not going to pay you full fair value. So if you look at my expected value, there's a 90% times my going concern value, which you saw on the previous page, plus a 10% chance of failure times half of 29.6 billion, gives me an estimated value adjusted for failure of 28.09 billion. I'm almost at the end. I have to convert that value into a value per share. To get from the value of the operating assets to the value of equity, and then to the value of equity per share, I've got to start by adding back things I haven't valued yet. In the case of Airbnb, that would include cash, because I haven't added that back yet. They have no cross holdings, so not that much to worry about. But there's one additional feature in an IPO. You raise money at the time of the offering, and that will go into your cash balance. So Airbnb is going to raise $3 billion. I do subtract out the debt, not a big number, 2.19 billion. And I subtract out any equity options I might have outstanding before I divide by the number of shares. I get a value per share of about $47.17. Dispense with the 17 cents, around $47, because there's a lot of give in my story, right? I could be wrong on many of the inputs, but this is my story converted into inputs into value. A couple of final loose ends might not be directly relevant to Airbnb, but you might run into with young growth companies. Many young companies, the value might come from a person or key people in the company, and if they leave, there's a significant effect on value. So what do we do about those? There's a component to valuation called a key person discount. Appraisers valuing young companies will often value the company and then discount that value for the loss of a key person. They often use an arbitrary discount, 10, 15, 20%. It should not be arbitrary. If you truly want to value a key person, here's what you should do. Value the company with the status quo. What does that mean? With the key people working for it. Then revalue the company if the key person or people leave. You should get a lower value, right? Less revenues, maybe less profits, more reinvestment, maybe even higher failure risk. The difference between those two values is the value of your key person or people. In the case of Airbnb, I think the value comes more from the platform than the person, so there is no key person discount to apply here. But with smaller companies, especially if they're built around personal services, there can be a key person discount. So we've talked about valuing a young growth company. Let's talk about the challenges of pricing a young growth company. The first is, when you're pricing a young growth company, you're capturing it early in its life cycle, which means you're going to get small revenues, big losses, negative cash flows, and a huge expected growth rate. That can be challenging to find other companies like yours. Second, you got this failure risk we talked about. How do you bring that into a multiple? Multiples are blunt instruments. They're not easily adjusted for failure risk. Third, what do you scale things to? As I said, young growth companies often have negative earnings, negative cash flows. Book value means very little, could even be negative, especially looking at book equity. And even the revenues are small. It's challenging to find a scaling variable. And finally, there is this liquidity issue, again, tough to bring into a pricing of a young growth company. So here are some solutions. First is, remember the numbers right now reflect where your company is in the life cycle. There's not much there because your company is very young. But in your projections, especially when you did a DCF, you made your company more substantial over time, given bigger revenues, perhaps even profits by the time you get to year 5 or 10. Those are called forward numbers. And sometimes to price young companies, it is better to scale the value you're paying today to expected revenues in year 5, expected earnings in year 5. Remember, if you do this, you got to do this for the other companies in your peer group as well. But I think you might get more reasonable estimates of pricing by pricing your company based on what you will look like in year 5 or 10. So let's say you do that. You take earnings which are positive in year 5, you apply a multiple to come up with the estimated value in year 5. Remember, that pricing that you do in year 5 shouldn't reflect your company as it is today, but as it will be in year 5. You see, what? Remember, right now your company is a high growth, money losing company. By the time you get to year 5, the growth will probably be lower because your company has scaled up. So you have to price your company as if you were in year 5 with the growth and the risk and the earnings you have then. And even after you've done this all, you still have to adjust for the time value of money. This is your expected pricing 5 years from now. You got to bring it back to today. That's the time value effect. And you have to stop and ask the question, will I make it to year 5? That's a failure risk. So let's try this for Airbnb. I could price Airbnb based on hotels. It is in the hospitality business, or based on the two big booking companies out there, booking.com and Expedia. I've actually applied both to show you how wide the pricing differences will be depending on whether I price Airbnb based on hotels or whether I price it based upon, booking companies. It'll also vary depending upon whether I use a forward pricing or a current pricing. So as an example here, if you take, let's say I scale, I use hotels as my peer group and I scale to revenues. Right now, my revenues at Airbnb are about 3.6 billion, but by the time I get to year 5, my expected revenues are 12.07 billion. If I apply the multiple of revenues that hotel companies trade at, 2.92 times revenues, to my current revenues, I get an estimated enterprise value of about 10.6 billion. That is if I use current revenues. If I use revenues 5 years from now, 12.07 billion, I get an estimated enterprise value of 35.2 billion, but I've got to adjust the 34.2 billion. First, for time value of money, that's the 8.5% discounting back 5 years. And second, for the fact that there's only a 90% chance of survival. But even after those adjustments, I get a value of 21 billion. Incidentally, I get higher values for my company if I compare it to travel booking companies than to the peer group of hotels. And I think booking companies actually make more sense. If you ask me for a pricing for Airbnb, the number I'd probably come back with is about $28 to $29 billion, which is where I end up, using both revenues and gross bookings as my scaling variable and using forward numbers rather than current numbers. So can I price Airbnb? Yes, but I will run into many of the challenges I would with the valuation. So I valued Airbnb, I've priced Airbnb. One final point before we leave this topic. Let's say you valued and priced a young growth company. It's always good to stop and ask the question, have I missed something? What might you be missing? Well, if your company is in an existing business and it succeeds, there's a chance that it might be able to get into new businesses. It's called optionality. Success in a business might give you a platform to get into new businesses. Let's make this specific to Airbnb. Airbnb is a platform, right? In my valuation, I've looked at how that platform can be used in the hospitality business. But there are more people coming on the platform each year, and nothing restricts Airbnb to be just in hospitality. What if they could find other businesses that they could get into where their hospitality platform helps them enter those businesses? What does that mean? Well, my intrinsic value will not capture that extra optionality. Now, it's very difficult to actually price or value that option because there are option pricing models out there, but they're not designed for this kind of option. It's tough to get a number. But it does mean that when you come up with an intrinsic value, $47 per share for Airbnb, let's say the stock is trading at 50 or even at 47. You might say, look, even though the stock looks fairly valued, I will buy the stock at 47 because there's upside there, which I haven't captured in the 47. I know it sounds fuzzy and subjective, but people do this all the time with young growth companies, especially with platform companies. And I'm suggesting that there is a good reason for paying a premium on the intrinsic value if there's optionality. But check to make sure there is optionality. Optionality comes from you having something exclusive. For Airbnb, it's that platform of users where you can fashion products and services specifically to whatever you have exclusive. So again, don't do any somersaults in the process of valuing companies to bring these in. Do this at the end of the game. Thank you very much for listening, and I hope you found this session useful. Take care.